I come from the 2008 investing period. These prices won't go down. They won't go down to what they originally were. It just won't happen. And people seem to think that they're waiting for that. And it's not going to happen. Okay. All right. On this podcast, we are going to be talking about the Phoenix deal and what we have going on with it and why certain things are changing about it. And also maybe some Windsor updates, Windsor market updates and a little bit of things like that, because that's actually something that I'm kind of curious, because I'm starting to see some things going on, and Scotty getting lit up on Twitter about some things.
Okay, there's some social media stuff too. I know you're getting lit up as well, so
man,
that'd be an interesting topic.
Yeah.
Let's start off with Phoenix. So just so everybody knows, right, when you have it locked up in a conditional period, that you don't necessarily have the financing locked in, right? Yeah.
So this is. Let me give everybody a little bit of background here. So the Phoenix deal, we came to an agreement probably about mid-January, and the loan that I was going to put on there was a Fannie Mae loan. And Fannie Mae is an agency lender. I guess it would be somewhat equivalent to like a CMHC type of loan or backed loan or something like that. It's a government-backed loan. And right now, the reason why these style of loans are very attractive is because they offer long-term interest only. And since in Coachwood Capital, we're not going to be holding the property for 30 years, the hold period is going to be anywhere from a few years to maybe around 5 to potentially a few years more, depending on what the market's doing at that given time. So,
well, I love what you said too. Most of the first 5 years of payments are interest anyways.
Way more than first 5, probably first 10.
And if anybody looks at an amortization chart for a mortgage, you're going to see interest payments go like this.
Yeah.
Very slowly, and then it starts to get absolutely hammered out at the end. But for the first 5-10 years, it's...
Yeah. And that's why, and then not only does that make it attractive being into a deal for less period of time, especially with rates higher, where and having sellers not willing to come down, because listen, whenever prices raise or increase, they never go back to original price. Never. It never happens. So
people should listen to this.
It's
so
never
true.
that never happens.
And that's true in not just real estate. It's true in every category of goods and services.
I've never seen, and I've been in business for myself for 15 years. I've never once seen, and I deal with commodity brokers all the time. I deal with manufacturers of raw materials all the time. Whenever they have a price bump because of, market conditions or environment conditions, like I've seen pricing change from anything from hurricanes. I've seen prices change from pirates. Like, this is I'm not even joking. You laugh, but this is actually a fucking thing. We had a situation at one point when we were buying, for example, like New Zealand Way. New Zealand Way has to come from obviously New Zealand, and the shipping route was being attacked by pirates. So man. What the shipping route, they had to reroute all of the ships, and it was taking much longer on the open sea to get to ports. And because it was taking much longer, there was like way more gas involved, and the companies weren't like, it's a waterfall effect, right? So pirates. One time, I had a situation, like this was more of an isolated situation, but we had a manufacturer that one of the trucks blew up on the freeway. They got into an accident, a minor fender bender. Somehow a spark happened where there was some powder floating around in the back of the semi truck and ignited the powder that was floating around and blew the whole...
protein powder?
Protein powder, dude.
I didn't know it was flammable. Combustible. Holy smokes.
It is combustible if in like the perfect scenario.
Yeah.
And it blew the fucking truck up. Yeah. So I had to wait to get my product. I had to, there's so many different
There's so many
things.
Inflationary things. Yeah. And one of them obviously is COVID. Like it's shipping prices,
exactly.
lumber,
so
all that
you have
stuff.
COVID, and then but no matter what, I've never seen things go back to the same price prior to the raw material purchase price prior to certain events happening. It never does.
Yeah, it'll come down off of its high, but not to its original
never
price point.
And the same thing happens with real estate. Yeah. People I come from the 2008 investing period, 2007, 2008, 2010, 9, whatever the fuck. I come from that period, and these prices won't go down until, or they won't go down to what they originally were. It just won't happen, and people seem to think that they're waiting for that.
Oh man,
and it's not going to happen. So
it's almost impossible.
Yeah,
it's almost impossible.
With all that said, one of the advantageous reasons to go with an interest-only loan from an agency, or to go with agency, is because they offer interest-only, typically longer periods of time of interest-only. The fact that you're not really paying down any equity in the first at least decade of ownership, it makes sense to go interest-only. And if you actually look at a lot of the larger scale properties that even like Grant Cardone does, for example, the majority of his large-scale properties in good locations with cap rates that, aren't, 6%, 7%, 8%, in order for those properties to even make sense and cash flow to get a return, you're going interest only.
You have to.
You have to do it, right? So we were going to go in on an interest-only loan. The problem with Fannie Mae is you can't rate lock when you send in your application. So I sent in my application, was approved, got everything going, but you can't rate lock until they do an appraisal, okay? Well, by the time we did our due diligence period, the rates had moved more than 50 basis points. So higher, yeah. So have increased by 50 basis, actually more than 50 basis points at this point. Now, when I went in at application, the rates were at 5.4%. Right now, they're a little bit over 6%. That's a big difference.
Huge. Changes the numbers and everything. Changes
exactly.
Everything. Yeah.
So it absolutely changes the numbers. So we went in on this deal at $5.4 million. For me to get the deal to work at the same numbers that we projected,
with the higher rates,
I'd have to come in at a reduction of around $500,000. So I'm going to be asking for a reduction based on a 4.9% purchase price at this point now, which is a big reduction. But we have an interesting scenario. The seller's loan expires April 1st. Whether or not they're able to get into some other bridge loan or whatever within the amount of time that at this point it's like a month. I don't know, and I'm not necessarily trying to put them in between a rock and a hard place. That's not what I'm trying to do. I have my best interest at heart and my investor's best interest at heart. So the deal needs to work in order for me to move forward with it. If it doesn't work numbers-wise, I don't move forward with it. And I'm not going to get pregnant in the deal without knowing whether or not they're going to start accepting a retrade price. So, and when I say get pregnant in the deal, what I mean is like sending the financing fee, right? The financing fee right away, $25,000. Third parties, $25,000. So for me to even get the ball rolling on my financing contingency, I'm $50,000 deep. Mm-hmm. Non-refundable shit.
Yeah.
Okay.
And you're not going to go and do that at the original purchase price.
No, because the original purchase price doesn't work anymore at those rates. Now, typically what we've seen with the 10-year treasury, and now this particular loan is based off the 10-year treasury, and that's what bumped and changed the rate. Now, typically, if you bring up the 10-year treasury, Connor, bring up the 10-year treasury when you're doing this, you'll see it goes up, comes back down, goes up, comes back down. But the threshold was always 3.9%. Well, it broke through 4%. So, and that's the problem. So we're dealing with a very volatile situation right now. Not that that's a bad thing, because the whole idea of going interest only is still very attractive for a disposition in, say, 5 years once this property sells, even if the rates come back down. But I've told people this multiple times. They're like, well, what happens if the rates go down to like what they were, at the start of COVID or whatever, where it was like only a couple percent? And I'm like, listen, I did a deal. I did 2 deals. Well, maybe one deal for sure prior to COVID. I did that Camp Manor
in
deal.
the U.S.
In the
large
U.S.
multi.
Yeah, large multi in the U.S. And then I did another deal, the North Miami deal in the U.S. and both of those lined up right around like 3.85%, 3.9%, and that was at the fucking lowest point of interest rates in history.
And it was still close to 4.
And it was still close to 4. So even if rates come down to 4, a 6% interest-only loan is still a good deal. And when rates come down, banks are less likely to do interest-only full-term. See what I mean? So now you can assume an interest-only full-term loan.
Yeah, and
it's perfect.
And of course, the benefit if rates come down, the cap rate comes down as well, and the value of the building goes up.
Exactly.
And you can decide, hey, well, we're not going to hold this for 10 years. We're going to sell it now, right? The market's hot.
Exactly.
Money's cheap.
Exactly.
We paid X amount for this thing. We're going to sell it for $8 million.
Exactly.
So,
and now what we can do is like they're going to have to get a supplemental loan, right? Which is more than likely if the rates come down, it'll be a principal and interest loan, okay? Because they're not going to be able to get a supplemental loan or even a full loan. If they wanted to cash this out, they're not going to get a full-term IO loan. They're going to have to get a supplemental principal and interest. But if they can get the bulk of the debt as interest only, and then do a supplemental principal and interest loan, that fucking thing will cash flow for them like crazy.
Better. Yeah, you're talking about the prospective buyer in this hypothetical scenario.
Exactly, yeah.
But this is why it's so important, and we always preach this. We don't buy for appreciation. We're buying for cash flow. We're locking in the debt.
Exactly.
And then we're buying in markets that are attractive with rising rents, limited supply, and rising populations to push the value of the building up long term.
Yeah.
We don't count on it.
No.
But realistically, rents are going up, right? Inflation's normal in our monetary system.
Yeah.
The value of the building is going to go up. Rents are going to go up. Mm-hmm. We're more concerned with locking in the debts and locking in the cash flow.
Exactly.
People like the ability to lock in cash flow in an environment where you're seeing rates like that 60 basis point jump in a 2-week window based off of an inflation data report that was too high.
Yeah.
Like, this is not normal.
I know.
So the ability to lock in cash flow and interest rates and put your money somewhere where you're at least breaking even with inflation, like probably even better, is very hard to do right now. And that's why this deal was so attractive, and it still is. If the we just have to get the numbers back into balance.
Exactly.
And a retrade for you means to basically
price
renegotiate.
Reduction. Yeah, price reduction. Yeah, they call it retrade in the States.
Yeah. Or not in the States.
Exactly. Yeah, okay, fair enough. Price reduction.
Yeah. So
a couple other things that are happening too with the deal is the pro forma that they put out isn't necessarily coming to fruition as fast as they as quick as they had thought. Why is that happening? Well, there was an Airbnb unit in the property, and I said as part of my due diligence, I want that Airbnb unit taken care of. However, when they
you don't want them running.
I don't want.
Airbnb.
Yeah, I don't want them. I don't want to assume an Airbnb. One of the reasons, and not to say that I don't necessarily disagree with having an Airbnb unit. It's because I don't want to have to manage an Airbnb unit in a non-Airbnb building. Okay,
absolutely. One random unit doesn't make sense.
Yeah, one random unit, and also the person that was renting that or essentially subleasing to Airbnb tenants changed the locks. So already there. Not okay.
Red flag.
Huge red flag. I don't want to deal with that. So what ended up happening was that vacant unit plus another vacant unit that they had, that vacant unit that I essentially, they were already getting rid of this person anyways, but it happened to be that the eviction happened in January, brought the vacancy rate down by another, say, call it 5%, right? Because you're around at 23 units, you got one vacancy, you're around, 4%, 5%. You bring in another one, all of a sudden the bank gets that, right? They get that income statement or rent roll for January. Boom, you've got 10% vacancy along with an economic vacancy of say around 20%. That's a problem for the bank. The banks want to see an economic vacancy of 90% or 10% or better. So, and then they have concessions. So the way that the area in Phoenix right now is working is they're doing 13-month leases, the first month free. Well, this being a new building and a new basically a rehabbed property, they haven't had enough time for the, say for example, a T3, like a trailing 3 months of an income statement, for the concessions to burn off. So as soon as the bank sees that, it's dropping the rental income, like the net rental income, it's dropping the net rental income, and it's reducing the LTV on the property or the proceeds for what the bank is willing to loan me, right?
So interesting. So just so everybody's clear, banks don't think outside the box.
No, they don't.
You hit them with the pro forma. Yeah. You can explain it very clearly by saying, hey, we evicted this Airbnb unit. We're replacing it with a long-term tenant. It's actually going to stabilize the building and less risky. They don't care. You need 3 months pro forma. It doesn't matter what you say. That's messing up. It's putting kinks into the deal and delaying things.
Exactly.
Right?
So another scenario. So I convinced the lender to give me to work off of a T1. Okay, because I'm convinced the submarket is great. There's so much. The fundamentals in the submarket are so fucking deep. I'm like, guys, and then I told them, you guys have to have a network in the area. These guys are actually that I'm working for are from California, Southern California. I'm like, you guys have to have a network in the Phoenix area. They're like, we do actually. Let me contact the Phoenix guys. They got Phoenix guys on the ground in the area saying yes. This area in Phoenix is blowing up. This I can't say enough good shit about this area. So the guys over in San Diego that I'm working with on lending are like, okay, perfect. We're going to make the exception. We're going to work off a T1, a trailing T1. The fucking problem, though, is the concessions. They're not burning off fast enough, right? So there's a couple concessions that are still in place for February, which we have numbers for, right? But now we're in March. So what we're doing now is being March 3rd? We're waiting for the March 3rd rent roll to come through and collections, right, of March to come through. And we're going to use the collections from March with February's expenses to put together a pro forma, fairly accurate income statement to give to the bank as a T1 to try to get the deal done.
A lot of hoops to jump through,
to try to get the deal done, and so long as they accept the retrade. Which I'm going to tell you this right now, the agent that I'm working with on this right now, he hasn't explicitly come back and said, hey. And this is something that you might want to touch in being an agent. He hasn't come back explicitly saying, I already brought up this retrade price that I'm coming in for a reduction. I brought it up like fucking probably a week or so ago. I already did this, okay? He hasn't explicitly come back and said, hey, I put the bug in the seller's ears. We're good to go with a retrade or whatever. Let's figure it out. I guarantee to you though, they already know about it. There's no way. Tell me right now, if you had a client that, because I'm not bringing my own agent, okay? So I'm working with the seller's agent, okay? Are you going to tell me that if you're working with a seller's agent, or if you're working with sellers right now, and I come back to you because I'm working with you on buying the property from your sellers, and I tell you, hey, I'm coming in for a price reduction, are you not going to get the seller's prep for that? Number one, and are you going to tell me right now that you wouldn't still continue with the deal if you didn't know, or if you knew that was coming? See what I'm saying?
Oh, absolutely.
So number one, those sellers know that there's a retrade price coming for sure, right? That's number one. Number two, I gave him the word of roundabout number where the retrade's coming in at. Based on that, there's no way that they're not accepting this deal. Or there might be at least some sort of negotiation that they're willing to play ball. Guaranteed.
Well, they're, like you said, they're kind of between a rock and a hard place, which
potentially,
is potentially. Yeah. Sometimes that's the only way you can negotiate. For a cash flowing building in a great market, they might not need to sell, although their business model isn't to hold, right? They're flippers.
Their business model isn't to hold.
So they're flippers. They want to get their capital out. They purchased it and renovated it. They have a pretty healthy margin of profit, right? That's one thing we look into as well.
Yeah.
And of course, right, as an agent myself, if I smell blood and also I'm only doing the deal if the numbers work, then I'm going after the reduction. If I don't get it, we move on to the next one. And that's what I love about working with you, obviously, on the we're numbers guys, right? You're not going to emotionally tie me into this building or this deal. If the numbers don't work, we're gone.
It has to be that
and they're
way.
going to know that, right?
It has to be that way. I might, if it was only my money, I might have come up a little bit on I might come up a little bit when I go in for a reduction if it was only my money, because I'm that confident in the market there. But it's not only my money. I have to do my best to try to get people to actually make good on those targets, for at least for appearances, right? There's always the unforeseen events that I can't control or that are out of our control. But
because we're so conservative with our numbers that we're not gonna, even though you might say, hey, this submarket, I'll take a little bit more risk here. Submarket's so hot. I'm not too worried about this percentage or that percentage. Yeah. But when it's other people's money, it's like, you know what? No, we got to stick to our super conservative numbers. We're not going to overproject the market. We're not going to overproject rent growth. We need to price at X or we're walking. So we're kind of a little bit in limbo there. Yeah. I should know within a. I was actually going to send him a note today saying like, hey man, you got any updates? Like how's March shaking out? It's just so interesting to see the back end, right? And we always talk with this when we bring something to market, when we start talking to our clients and people that are interested to putting some money to work, you just see the finished product, and you're not even seeing like 10 hours on the phone with lenders and the seller and the seller's agent. And then going back and forth with 10 different lenders and Fannie Mae and Freddie Mac to even put this product on the table. And it's, so I think a lot of people have a hard time understanding how hard these deals are to put together and how hard they are to find with numbers that work like this, especially in lieu of like just what's happening here in our local market.